We now expand on the accounting for issuing common stock. Common stock is the basic stock ownership in a corporation. The corporation's charter authorizes X number of shares of common stock to be issued. A par value is assigned to the common stock in the charter. For example, the charter could state that the corporation is authorized to issue 10,000 shares of $2 par value stock. They then are sold to the public. The holders of common stock elect the board of directors. In the event of bankruptcy and liquidation, the common stockholders are the last group to be paid after creditors or bondholders and preferred shareholders have been paid in full. Let's look at the accounting for the issuing of stock. If our corporation issues 10,000 shares of $2 par value stock for $10 a share, the corporation gets $100,000. The accounting entry is a debit to cash of $100,000. The credit is split between two accounts. The amount allocated to the par value is the designated par value amount of $2 per share. $2 times 10,000 equals $20,000. This amount is credit to the common stock account. The difference of $8 per share is $8 times 10,000 equals $80,000. This amount is credited to an account additional paid-in capital. When the transaction is posted to the ledger accounts, cash is increased by $100,000. At the same time, two equity accounts, common stock and additional paid-in capital, are increased. A corporation may want to repurchase its own stock on the open market. Maybe they want to give it out as a bonus to employees. This repurchased stock is called Treasury stock. Treasury stock is considered a contra equity account. The accounting for Treasury stock is a credit to cash for the amount the corporation pays out and a debit to the contra equity account Treasury stock. In this example, the corporation is repurchasing 1,000 shares of stock at $8 per share. The debit goes to Treasury stock and the credit goes to cash. The transaction is posted to the ledger. Notice the Treasury stock has a debit balance. This is an equity account, and as such, when it's put in the equity section of the balance sheet, it acts as a minus because it actually is a contra equity account. Here's how we would show Treasury stock on the balance sheet. Notice the contra equity account Treasury stock is shown as a reduction of equity. People purchase stock to get a return on their investment. They can make money two ways. The first way is the appreciation on the value of the stock. This is the increase in what the stock is selling for in the stock market. The second way is through dividends. Corporations pay their stockholders a dividend, which in essence is returning some of the money the corporation made back to the stockholders. Not all corporations pay a dividend. Some keep all their earnings in the business to grow it. But if they are paying a dividend, normally they do so every quarter. There are three important dates in the dividend process. The date of declaration is the date that the directors officially approve the dividend and how much it will be. The date of record is the date that if you own the stock on that date, you get the dividend. The date of payment is the date that the dividend will be paid. For example, the board of directors of a corporation on June 12th may declare a 20-cent dividend to be paid to the stockholders of record on June 26th, to actually be paid on July 3rd. If I have 10,000 shares of stock issued, the total dividend would be 10,000 times 0.20 or $2,000. Here is the accounting for a dividend. In our example, the board of directors declared a 20-cent dividend on June 12, 21X to stockholders with a date of record of June 26 to be paid on July 3rd. On the June 3rd declaration date, the corporation has entered into a liability to pay a dividend and must record the liability with a credit to the dividend payable account and a debit to the dividend account. The transaction is posted to the ledger. As you can see, we have a liability to pay a $2,000 dividend in the dividend payable account. No accounting entry is made on the date of record of June 26. When the dividend is paid on July 3rd, we would issue checks to the stockholders totaling $2,000. This would be a credit to cash and a debit to the dividends payable liability account. The transaction is posted to the ledger to zero out the dividend liability payable account. Sometimes a corporation decides to issue a stock dividend to its stockholders. A stock dividend is recorded as a debit to retained earnings, thus reducing retained earnings, and a credit to the common stock account. There is actually some controversy over how this should be done. The conventional accounting thinking says that for small stock dividends below 25%, they should be recorded at the market value of the stock. For those over 25%, they should be recorded at the par value of the stock. This example shows a corporation with 10,000 shares of stock outstanding. They issue a 5% stock dividend. That means they issue an additional 500 shares. The market value of the stock on the date of issue is $8. 8 times 500 equals $4,000. Per the journal entry, common stock is increased with a $4,000 credit. The debit goes to retained earnings, which reduces it. The transaction is posted to the ledger. In addition to common stock, some corporations issue another type of stock called preferred stock. Preferred stock has a variety of special features that the common stock does not. These features vary depending on what the corporation wants to offer. They include a fixed dividend rate, a conversion feature to common stock, and priority over common stockholders if the corporation is liquidated. Stock splits are not dividends. A stock split increases the number of outstanding shares of a corporation stock in a way that the proportionate share of ownership for each stockholder stays the same. Let's use 2 pies for an example. If I cut the pie into quarters, I have 4 slices. If I cut it into eighths, I have 8 slices. But regardless of how I slice it, the total amount remains the same. In this pie example, if I went from 4 to 8 slices, we would call this a 2-for-1 stock split. If I owned one slice when it was cut in quarters, and now I own 2 slices when it is cut in eighths, my total ownership is still 25%. The price per share immediately adjusts to reflect the stock split, since buyers and sellers of the stock all know about the stock split. In this example, the share or pie slice price would be cut in half. Some companies decide to split their stock if the price of the stock rises significantly and is perceived to be too expensive. There is no debit-credit accounting entry for a stock split. I now want to talk about 3 financial ratios that are used extensively to evaluate the profitability of a corporation. They are earnings per share, EPS, return on equity, RE, and the price-earnings ratio, the PE. These are not just textbook formulas. Business people and individual investors in the stock market are very familiar with what they are and what they mean. I use them every time I look at a stock to buy or sell. The earnings per share, EPS, is the most famous of all ratios. It tells me how much profit each share of stock earned. Earnings per share is often considered the single most important ratio to determine a corporation's profitability. We often look for trends and compare the earnings per share year to year. This ratio is most important because it can be used as a predictor of the future. If the earnings per share is increasing in our trend comparison, perhaps we can expect more dividends in the future. An increase in dividend could mean an increase in the stock price. Earnings per share is computed by dividing the net income by the average number of common stock shares outstanding. If I started the year with 8,000 shares and ended the year with 12,000 shares, my average shares would be 10,000. In this example, we end up with an earnings per share of $1.20. The return on equity, the ROE, also reports on the profitability of the company. It is another tool designed to give me a picture now of how my investment is doing. This tells me what is the rate of return on my investment. It is computed by dividing net income by average stockholders' equity. This company had net income of $28,000 for the year. They had beginning stockholders' equity of $300,000 and ending stockholders' equity of $400,000. Therefore, their average stockholders' equity is $350,000. $28,000 divided by $350,000 gives us an 8% return on equity. That means our investment in the company earned 8%. I like comparing the return on investment to the previous year's amounts and also to what the industry average is. While the earnings per share and the return on equity are helpful in determining the profitability of a corporation, they don't tell us if the company's stock price is fairly stated. Investors use a calculation called the price-earnings ratio, or PE. The market price of a share of the company's stock is divided by the earnings per share. In this example, we have a stock market price of $18 per share. The earnings per share is $1.20. $18 divided by $1.20 is 15. 15 is about average. Anything higher signifies that good things are expected from the company in the future. A lower amount indicates not so good, or maybe a low PE is a chance to buy a stock low that will do well in the future. My advice is to be careful buying stock, but also this is a good time to start developing your knowledge of the stock market and the various tools that can be used to evaluate your investments.